not using any lip kits from you. They're always lumping.
I don't like
feel
this.
like my mouth is on fire.
I thought you had that one.
No, I keep using yours, and then it shocks me every time I put it on. I go, shoot, like a hot salsa.
Welcome to the Now Making Moves in Real Estate podcast, episode 15. Our guest today is coming to us from Boulder, Colorado. He has been a mortgage lender since 1998, navigating through 2 recessions, several refinance cycles, and a challenging economy. Despite all those fluctuations, he has closed $76 million in volume this past year. So let's give a warm welcome to Brian Manning with the Brian Manning team. We're super excited to have you here today. And feel free to fill in, some more background information for our listeners on who Brian is.
Wonderful. Well, thanks for having me. I'm really appreciative of the opportunity to be here, and I'm just excited to talk about the content that we're going to go through. Let's see a little more background. So I've been doing this for 25 years. 2008, 2009, I lived in South Florida at that time. So I moved to Colorado 13 years ago. The market at that time was not good in 08, 09. That's when we went through the Great Recession. I went through bankruptcy, foreclosure, pretty much lost everything I could at that point in time and had to rebuild and start over. Probably a really good lesson to learn because I did really well up until then, and probably wasn't bad to get knocked down a little bit and have to start over. I think you really kind of figure out what you value in life and what's important to you when you go through some struggles like that. And I'm not upset that I went through that. I feel like we learned some good lessons. And then moved to Colorado 13 years ago. Didn't know a single person here. And again, I've been doing this 25 years, so it wasn't like starting something new. But we were starting from scratch, and we just went at it really strong when we first got here. And then, our volume's done, well. Even what I would consider to be a down market last year, I feel like we did pretty well. And we're just, fully in growth mode right now. That's it.
Well, I can see that because I think we left out a couple details about you that I may or may not have pulled from your Instagram account.
Okay.
I've been following you. But for one thing, you've closed over 5,000 deals, and you have something in common here with Miss Michelle with being in the top 1%.
Nice.
Top 1% in the pharmaceutical.
Yeah.
Awesome. Congratulations.
Thank you.
Impressive for you, Brian. I mean, my goodness, you definitely are in growth mode, it looks like.
Yeah, I just feel like it's, it's either the on or off button. And if we're going to have the on button on, we might as well go for it, until one day the on button can no longer be on for whatever reason, whether you elect for that to turn off or not, and then, but if it's going to be on, might as well give it all, or go do something else that you can give 110% to. Whatever you want to do, like it should just be all or nothing,
Right. Oh, we so agree.
Pedal to the metal.
That's right. Exactly.
Do it now.
Yeah. Well, let's dive in because we know that you have some significant experience and preparation to guide our audience on how to prepare for the changes that are ahead of us this summer with the NAR settlement. So walk us through what you're unfolding in your market and to your clients.
The first thing I would say is I think the NAR settlement will be good. And here's what I mean by that. A lot of realtors would disagree with that initial statement right away. But the reason why I say that is I think that buyers' agents have been just beat up so bad for so long. And what I mean by that is you might think you want to work with the buyer and you might want them to sign a buyer agency agreement, but you're reluctant to get them to sign that because the realtor down the road will say, oh, you don't need to sign this, hop in my car. And it was very incongruent, the process that was taking place previously. And maybe, you were reluctant, but to have them sign it, but someone else just didn't care. And then when they went under contract, they finally had them sign a buyer agency agreement. So I felt like buyers agents were just really beat up before in the process. Whereas, now this should really level the playing field. But not only in leveling the playing field, the potential requirement for a buyer agency agreement in the beginning to secure your cost and your fee, the realtor with strong presentation skills is going to win. And the realtor that's very focused on their presentation skills, a scripted process that's replicatable through other people on your team, really demonstrating the value that they're going to bring to a buyer, will have no problems getting that buyer agency agreement signed. So I really feel like the challenges that were out there before and where it was kind of very an unequal playing field, that it's going to get leveled really quick. And I think when it gets leveled, there is a very strong group of agents that are super motivated to dominate in the market and really figure this out. And they're going to do really well. And the other people that don't have that kind of motivation will get moved off to the wayside, which really pulls me back to thinking that the person that has a scripted process and really focuses on a solid buyer presentation, they're probably going to do more volume than they did before, because these people that, can't hack it, that don't have the skills to explain why you should sign this agency agreement with them, they just can't survive. So I think there's some leveling that will take place. If we look at this, I think a great way to look at it is that, change is just opportunity in disguise, right? And change stirs the pot. So competitive people, and you two seem rather competitive people like change and embrace change, because change, if you think about it, if we don't have change for a long time, too many people figure it out and too many people start doing what we're doing, right? So when you have change and change stirs the pot, you have to go figure it out again, and competitive people will figure it out. They will get back to the drawing board and they will start working on their buyer presentation, but it will move a lot of people out. They can't adapt to change. So I think that with change stirring the pot, really quickly, it's really going to work well for people like yourselves that are, definitely planning for this.
I agree. I think we're hearing the latest stat of around maybe 500,000 or so realtors are anticipated to exit, and not just because of this, just it's the nature of our industry right now. I think we saw 400,000 already leave. You could correct me if I'm wrong. So I'm excited. We're definitely one of the ones that see as an opportunity.
Absolutely. And I think that, so now it pulls us back into, what does the buyer presentation look like? Is it a scripted process? If you look at this, it's insane. So Mike Ferry would say that 9 out of 10 realtors and mortgage lenders don't have a buyer presentation. Mm-hmm. And I've talked to a lot of realtors and leading into all of this, and I've asked them, how are you going to convey your value to a buyer? And they don't really have a great presentation in place. And then in addition, unfortunately, not having a good presentation, what we really need to look at as well is what's called anticipatory service, right? So when you're going to sit down with a buyer, what does a buyer want? What does a seller want? And what does a listing agent want, right? Because there's 3 parties involved in negotiations. So the first thing we got to look at if you're building your buyer presentation is, what does a buyer want? Well, most people think a buyer is focused on price. But if you look at, so NAR puts out profile of a home buyer and seller every year. It's really incredible data. And NAR will tell you that the first thing a home buyer wants is to win their home. That's number 1. And then number 2, behind winning the home, is going to be monthly payment. So if we think about that and you think about your buyer presentation, if the first thing a home buyer is focused on is winning a home, right? When you're sitting down with your buyer and you're going through your buyer presentation, how are you explaining to them how you negotiate and how you help them win? And I can tell you from looking at a lot of buyer presentations that no one sits down and really elaborates how you as an agent negotiates on your client's behalf and how you help them win. Because the first thing they want to know is, how are you going to help me win this home? Then the second thing is payment, right? So, and then third behind that's going to be price. So, if we're looking at payment as being valuable right now, then we have to start looking at inventory levels, because I think inventory helps guide buyer behavior. What I mean by that is, if you have very low inventory, if your days on market is 20 days, you're probably not going to be able to go in and ask for a seller credit, right? Because you might have multiple offers in a home. But in a transitional market, you might have a home that sits on the market for 2 months, and that is a potential opportunity to go in and negotiate seller credits and help buy the rate down. So you can look at ways to create affordability with your clients and the offer process. But the first thing we have to do is really educate them on, what does inventory look like? because the offer that you're going to make on their behalf is really driven by inventory levels and if there's multiple offers or if it's been on the home for a long period of time. Because if it's been on the home and you can negotiate seller credits, then as the mortgage lender, we can use seller credits to buy the rate down. And if they can buy the rate down, now you're creating more affordability because payment is the number 2 item that they're focused on. So again, if we circle back to most buyer agent presentations, first, they're not explaining how they negotiate on the buyer's behalf. Second, they're not explaining how buyer behavior should work based on inventory levels. And price is really just a byproduct of comparable sales and inventory levels. So price is the last thing. And then the best way to think about price would be this. Let's just say one of you leases a car, right? So you found the car, you lease it, you lease the car because you love it. It's, it resonates with you for whatever reason. And you know your payment every month. But do you know how much you paid for that car through the lease? No one does, because price is last on the list. So if we think about, this NAR settlement, and you think about as agents, how do you want to win? Then for me, it pulls us really deeply back to that buyer presentation. And we really look at this. So anticipatory service would mean, how do you create a buyer presentation that is addressing these issues before they ask them? Because this is on their mind, because this is like 84 to 88% of all buyers. This is what troubles them, and this is what they're focusing on. So anticipatory service would be crafting your presentation to sit down with them and address all these items before they can get to it. So if we think about the buyer side, I think that's a big focus for us right now. You were gonna say something?
Now, well, I was just thinking along the lines of a little more of the nuts and bolts logistics of getting paid. Okay, so you're a buyer's agent, and you have to have the buyer sign that they're going to pay you a certain percentage. Whatever's on that contract is the maximum you can be paid, is what we are told. Even if a listing offers, and if the seller ends up offering, say, 3%, if you sign a contract with your buyer, it's only 1%, then that's what you're getting paid. But let's say that we have a seller that's willing to pay the compensation. What kind of changes are we looking at from the lending side of it? What kind of wording do you think we're going to see that we need to use? Because it's, this is new that we're writing compensation into contracts.
Right. Absolutely.
That was a no-no for a long time. So.
Absolutely. That's a great question. So Fannie Mae and Freddie Mac already came out and they said that a buyer can receive, you can have compensation written in like that goes to the realtor, and it does not impact any other credits that a buyer would receive from a seller. So like, let's just say you have, 2% credit, you can add that into the mix. So Fannie and Freddie have already come out and they will allow that to go into the transaction. And if Fannie and Freddie announce that, then most will follow suit. So now you got to get FHFA to get on board. So that will cover FHA transactions. And then VA has not allowed this for the longest time. VA probably has to go through like legislation that would change because that's a VA loan program. But I wouldn't be surprised if you would see that follow suit as well. So that would cover the main conventional FHA, VA, and then jumbo investors typically will follow suit behind Fannie and Freddie. So I wouldn't be surprised if you see them get on board as well. So, I think what you're asking is, so if you have a buyer agency agreement that says you're going to get paid 1%, and the seller comes out and says, well, we're paying 3%, there's 2% on the table. How do you utilize the 2%? So, the buyer could utilize that 2% and buy the rate down.
There you go. Which would be amazing. Now, back to the VA a little bit, because we've had multiple people on the show that help veterans. Are the VA buyers, would they even be allowed currently to pay a commission to their buyer's agent? Or
Not right now, no.
A window where we're going to have to just
That's correct.
hold off.
That's right.
That's what I was wondering.
Yep. Not right now. So that's going to take negotiating on the seller side, from your side with the seller to have the seller pay it.
Okay.
Yep.
Okay. Interesting.
What I love about everything that you just talked about is it's a very consultative approach, right? Like I think there's been so many times in our industry of late that the conversation has been around interest rates and high interest rates and interest rates, everything that, while you touched on the price component of the presentation, you just took like a very consultative educational approach.
Right.
And I love that.
Yeah, I mean, the example would be if I was going to go buy a house today, I would wait for the right house and I wouldn't pay market rate. I would find the right house. I would negotiate. I would get a seller credit, and I would either use that for a temporary 2-1 buy down or a permanent rate buy down. Because why not? And I think, the challenge is the average realtor rebuttal to interest rates is, yeah, rates are high, but you can always refinance. And that's okay because that's just what's generally said in the industry. But if you're a buyer, does that make you feel good? Does that make you feel like, oh, I should go buy right now? No. But the agent that is really aggressively explaining, not aggressively in a bad way, but really showing like, here's my offer process. Here's how I help you win. Here's how we keep all of our deadlines, authoritative and short. Here's how I get credits. Here's how you can use a credit to buy your rate down. Those people are going to do really well right now. Yep.
Why don't you explain a little bit of the difference between just, the 2-1 buy down versus a normal rate buy down?
Yeah. So a 2-1 buy down, let's just say today's interest rate is 7%. So a 2-1 buy down means for the first year, your monthly payments are based on an interest rate of 5%. And then for payments 13 through 24, they're based on a rate that's at 6%. And then for the remaining 30 years, so 3 through 30, they're at the regular 7% interest rate. So you get your monthly payments based on a reduced interest rate for the first 2 years. So that's a 2-1 buy down. A permanent buy down would say if your interest rate today is 7%, for X amount of dollars at closing, you can permanently buy the rate down. And instead of your rate being 7%, maybe it would be 6.25%. So the difference would be one buyer is going to feel that they will have an opportunity to refinance in a couple of years, and they'll be okay with the 2-1 buy down. Another buyer is not going to be confident that rates will move lower, and they're going to want security in the transaction, and they're just going to want to get the lowest rate right now. I don't think there's really a right or wrong answer there. I think it's about the financial security that the buyer is looking for and what makes them the most comfortable in the transaction. But I think what's important to note is on a 2-1 buy down, at least for me personally, we're always looking at the end payment, right? So years 3 through 30, and we're always making sure that if you take a 2-1 buy down,
afford it.
And you can't refinance because maybe you can't, we all think you should be able to, but if you can't, does this payment meet your needs? And I think that's really important. So I just pulled this back from 08, 09, when I watched a lot of our clients lose their homes to foreclosure and short sale, that, everyone took 2 and 3 year ARMs. And when the ARMs became adjustable, they couldn't refinance out of them. And then we had a lot of problems. So now we're super focused on really ensuring that end payment is okay with them. And if it's not, they have to lower their price, or I just can't do the loan for them. It would be the wrong fit.
Part of healthy homeownership, which is our mission.
That's right.
I remember all the talk about the buy down when that first came out, me coming into the office going, Courtney, this seems like some hocus pocus stuff where we're going to see people in a couple of years not able to refinance and afford those payments. And I was like, immediately, she's like, had to explain it to me because it's not my strength at the time. So yeah, I had the same concerns because that's something we certainly want to avoid.
For sure. Well, I think part of the difference is in 08, 09, let me back up. Right now, when you qualify for a mortgage, you're getting qualified based on that payment that you would have for years 3 through 30. And 08, 09, if you took out a 2-year ARM, you're getting qualified at the payment on the 2-year ARM, not what it would adjust to in the future if rates went higher. So from a qualifying perspective, it's a lot safer and more secure now from a lending side to ensure that they will meet that. Now, with that said, you could go to a debt to income ratio of like 49%, which is almost half of your income going towards obligation, mortgage payments, et cetera. Yeah. So we still want to be really careful because even though they might qualify on paper, by the time they have bills, daycare, whatever their expenses are, that payment might be too high for them.
Right. So, I mean, I know we don't have a magic 8 ball and we wish that we did, but just in your opinion, professional opinion, what are you thinking with rates? That's like the magic question, right?
That's a tough question. Let's see. I think, so let's see. I think there's a couple answers there. So the first thing we have to look at is what the Federal Reserve and the U.S. Treasury are going to do. So what I mean by that is when they went through COVID, they implemented what's called quantitative easing, right? So they had to buy mortgage-backed securities and they were keeping mortgage rates low. So they got this balance sheet that swelled to trillions of dollars. And now they're selling off these securities into the market. So you think about it, if you're an investor, we're originating new loans. So we're selling mortgage-backed securities, and the Federal Reserve is selling mortgage-backed securities as well. So you're flooding the market with a lot of securities being sold. So when you're flooding the market, to entice people to buy these securities, rates have to be higher, right? Because you want people to buy them. So now the Treasury already announced earlier today that they're looking at slowing the runoff of their balance sheet. And today is Fed Day. I'm actually really curious to see what Jerome Powell says, because in the last Fed meeting, they alluded to the slowing down in the runoff of their balance sheet, and they just said very soon. So today actually is going to be, I think, really pivotal. Watch the Fed meeting, see what they say, and see if there's any mention about the slowing down in the runoff of their balance sheet. So that's one thing. Right now it's looking like, and really in total, it could be like a 12% or so reduction in the runoff. That would be impactful for interest rates alone right there. All right, so that's one thing. The second thing is the Federal Reserve's mandate is price stability. So that's to control inflation, and also employment in the US. Well, inflation, according to the Federal Reserve, seems kind of sticky right now. Their goal is to get to 2%, and what they look at is really hovering in that like 2.7% range. So just based off inflation alone, it would be unlikely you would see the Federal Reserve cut rates, because right now it's kind of hovered at that level for about 3 months. So that for right now, what I would say would be off the table. So the next thing we have to look at is, what does employment and really unemployment look like? When you start to see unemployment tick up, when unemployment gets to that 4.1% range, 4.1 or so would definitely be a catalyst of the Federal Reserve cutting interest rates. So, if we look at this, I think there's a little bit of a disconnect right now, because if you look at, a National Association of Small Businesses, if you look at what's happening just like with small businesses and just interviews at companies, you're seeing people get laid off. But if you look at the BLS report, the government report that comes out, it's showing quite a rosy job picture. So I think right now there's a little bit of a disconnect in what you're seeing in the real world versus the data that we're given. And I'm not a conspiracy theorist. I'm only looking at factual numbers. And I think eventually you should see that BLS report catch up. And when you start to see unemployment tick up, that's going to be the other catalyst for Federal Reserve to cut rates. So me personally, I don't think you're going to see them move rates lower, if anything, till the end of the year, because unemployment's not moving that much right now. Inflation's kind of sticky. But watch what Jerome Powell says today, because that will start to be a catalyst in a direction of lower interest rates.
Okay.
Now, can I say one more thing though?
Yeah.
You can.
With that said, hands down, I would be buying a house today, no questions asked. And here's the reason why I say that.
Rush.
Yeah, and for the rush. So I would rather think about this. So in 2021, if I wanted to go buy a house in Boulder, Colorado, yes, I got a lower interest rate. I would be paying $200,000-$400,000 more out of pocket to win. So yeah, my payment right now might be, depending on your price range, $400 to $1,000 more per month. But I just kept $400,000 in my bank account, and I was able to negotiate a price. So the difference of lower rates and chaos in the market versus higher rates in negotiation, to me, there's a huge savings there. The other reason why I say it is, I always look at real estate as a long-term hold, right? If you want to buy it and sell it in a year to make money, you're now an investor. So they need to call you to and say, hey, I'm an investor, and that's a whole different strategy. But if you're buying a home for your family and you buy it today and you're going to own it for 10 years, no matter what decade we look at, over 10 years, real estate always appreciates on every run, 10 years. Even if you look at 08, 09, if you look at that decade, appreciation was still consistent every single decade, all the way back to the 40s. So I'm still such a huge believer that real estate is the greatest way to create generational wealth. And regardless of where we are right now, if you own that home 6, 7, 10 years, you're going to make money. You're still going to do fine.
You heard it here.
I was just going to say, well said by Brian. I had a question for you. Are you licensed outside of Colorado?
That's a great
what other
question.
states?
So I am licensed in Colorado, Florida, California, Illinois, Wyoming, and Arizona. Now, with that said, 99% of my business is in Colorado. Because I spent so much time working in Florida, I still do get past clients that call us in Florida. I actually just spoke to someone yesterday. There was the third family I ever helped buy a house, which is amazing, from back in 98 or 99.
Wow.
So So I still do a little in Florida. We do some in Arizona because we just had a lot of people buying second homes down there. But even though I'm licensed in California, what I learned is that I'm not an expert in the California market. So if you call me today, I wouldn't do your loan there. I think you need to work with experts in the marketplace. I don't know your escrow process. I don't know your closing costs. I would do a disservice to your transaction because California is just, it's not my specialty. So I think you need to work with people. And I'm an even more believer in local. So, for me, we cover the whole state of Colorado. That's kind of local enough. But even Arizona, Wyoming, for me, is a little bit out of the comfort zone. I really kind of stray away from those.
Good to know.
It's great to know because we have friends in Colorado. So
Nice.
yeah,
Love
professionally and personally. So
Well,
Great.
This has been great, Brian. We really appreciate all of your information. Where can people find you?
Let's see. So Instagram would just be at Brian Manning Team.
although real quick on that, I don't know
Yeah.
that you need any followers, Mr. Just about just
We always
getting ready
need
to.
more.
I know, like you're just about ready to bust through what 100,000.
We're almost at 100. We would love
Yeah.
to break 100 this year.
Okay,
so,
let's do that. Let's
so
do
let's get
that.
in
Let's
there.
let's help Brian break 100.
We're so close. And our
Okay.
website is just brianmanningteam.com.
Okay, got it.
And what's the handle? One more time. I may have interrupted you.
It's at Brian Manning Team.
At Brian Manning Team, and we post this. We should put that in our.
That would be
in our-
great.
We will.
Yeah,
Yeah.
so we can get you over that tipping
I
point.
love it. Thank you.
Yeah. Thank you for joining us today, Brian. We appreciate all your insights and, just get savvy and educated and
That's
we
right.
can get through this.
Yeah.
It's pretty
100%.
basic.
100%. Well, thank you so much for having me. I'm really appreciative
Yeah.
of the opportunity to be here today.
Yeah.
Thank you, Brian.
Awesome.
Thank you.
Bye.
Bye.